The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
And joining us now to discuss the crypto markets today is none other than Travis Kling. He's founder and CIO of Ikigai Asset Management. Good morning, Travis.
Hello, thanks for having me.
Thank you for being here. So, as we were saying, it seems that the markets right now are flat, but nonetheless, we've been testing that $25,000 mark when it comes to Bitcoin, and there seems to be a lot of enthusiasm still when it comes to Ether because of the upcoming merge. So do you think that this is sort of kind of the beginning of a return in crypto, or do you think that some of the issues pertaining to, for instance, still some overhang about how aggressive the Fed will be when it comes to trying to fight inflation might put a damper on any risk on assets?
Yeah. So over the last few months, the crypto landscape has been dealing with very challenged macro and historically bad micro. I've been saying for years that Bitcoin loves QE and detests QT, and we've been in a backdrop of the latter for the last number of months here, which has definitely been a really challenged backdrop for all crypto assets. And then, starting, I think, with the Terra Luna collapse and then metastasizing into Celsius, 3AC, Voyager, all of the knock-on effect, that was about as bad of a run as the crypto ecosystem has ever had. And so now we've had on the margin improvements to both those, both the macro and the micro. And the macro setup has allowed traditional assets to kind of leak higher, equities in particular, which Bitcoin and crypto broadly have been quite correlated to over the last few months. And then, the micro just on the margin is getting better in the sense that, like, you don't have tons of companies blowing up left and right. And then you've got this, enormous catalyst in ETH merge that's really now reached a fever pitch at this point.
We've seen some excitement going on in the K9 related meme coins, the Doges and the Shiba Inus. What do you think that's telling us? Right now they're rallying significantly, and of course people are taking it as a risk-on sign. But is it really that? Is it really that people are more willing to take risk, or is it kind of very idiosyncratic? It's sort of like, okay, well, we're just going to play around in this one coin just because we've got nowhere else to go right now to bet.
Yeah, so I think anytime you look at the meme coins, you want to look at the meme stocks as well too. And I know that a few of those names have popped recently. I don't follow them nearly as closely as the cryptos, but I know I did see that recently. I still think, look, the adages of don't fight the Fed and it's all one trade. Don't fight the Fed's been in place for, I don't know, maybe a couple decades at this point, if not longer. It's all one trade's been in place for a couple years at this point. I think neither one of them have been more true than they are right now. And you can kind of, if you're long ETH, you can tell yourself that you're long the merge, and to some extent you are long the merge, but you're also just long broad risk appetite across all risk assets. And you can hate that or you can love that, but that is the state of things right now. And it wouldn't be my expectation that that's going to change that much. And so, I think it just helps to think through the broad appetite for risk assets in general, and how is the world thinking through the likelihood that, the S&P 500 is bottomed, for example, and that we don't need to go revisit the lows or make new lows. There's tons of back and forth about whether or not this has been a bear market rally in traditional. And I'm not married to one view or another. There are still a number of large macro risks that are out on the near-term horizon that could come to fruition over the coming months. I think the Ukraine conflict is still a major question mark about how that's going to play out, in particular with natural gas supplies from Russia into the European Union come this winter, which could be a really critical factor. Taiwan seems to be okay for the moment, but is, presents, maybe a relatively low likelihood, but an incredibly catastrophic risk were something bad to materialize over there. And then, let me just paint the picture for a second about what happened over the last few weeks in macro land, which is like you basically had Jerome Powell at the FOMC meeting at the end of July, who was kind of like dovish on the margin. He wasn't like dovish. If you never paid attention to what he said, you wouldn't listen to what he was saying and say, oh, that was like dovish commentary. You would have to parse through everything that he said for the last however many meetings, and then you would have to have a good understanding of like what expectations were going into that meeting, what positioning was going into that meeting, and then you could parse out a few sort of comments that he made. You say that was dovish on the margin, and everybody was super off sides in their positioning going into it, and that's what kind of caused the rally, the relief rally during and after that FOMC meeting. And then you had a big jobs number that kind of like gave the market some confidence that maybe we weren't falling off a cliff from a recession perspective, because the labor market is still holding in relatively strong. And then we just had this most recent CPI print, which came in at a 0% month over month and kind of started to lock in this sort of like peak inflation conversation, and then got people excited about, the Fed not having to just like hike to try and bring inflation. So like that's kind of this setup, but like 0% month over month inflation still doesn't in any way like lock in a strong downward trajectory. Like you can look at what the market is implying about a trajectory for both CPI and for Fed funds rates. I will tell you that if what the market is implying today comes to fruition, then that would bode, I think, very well for asset prices broadly and for crypto as well too. But I think you could also have something like a natural gas situation in the European Union that then metastasizes into a larger scale volatility event for the euro and for European peripheral debt, and then that blows out to like global assets like around the world. I think that you could totally see something like that happen over the next few months, and like there's still plenty of risk. So
for sure. So it looks like the picture going forward is improving, could be optimistic, yet there is a lot of geopolitical risk out there. I'm wondering what you're anticipating or what you're watching for at the FOMC from the minutes that will be released tomorrow.
I think just confirmation about the pace, confirmation about whether or not they're acknowledging some of the slowdowns that we've seen in other surveys, more leading indicators, right? Like the job market has remained strong, but the job market is a lagging indicator. And there's other more leading indicators that would tell you that it looks like the United States is rapidly moving towards a recession. And I think just, the minutes confirming or denying that. And then we've got Jackson Hole, in about 10 days here, and we'll hear from Powell there again. Because like right after the FOMC meeting, risk rallied so strongly, and they tried to wheel out those other Fed governors, I think, to try and talk the market back a little bit. And it wasn't like really effective. The market kind of like shrugged that off, and maybe we can get into why I think that happened in a minute. But like, if Jay really wants to put a lid on this rally, because financial conditionings are loosening, stock prices and bond prices have a material impact on financial conditions. And if they're loosening too much, like he can try and come with a lot more hawkish rhetoric at Jackson Hole and try and like back some of this out. You could see that happening. Like I said, I just think it remains to be seen. I'm not entirely sure what their intentions are right at this point.